I'm Emily Chang, and this is Bloomberg Technology. Coming up, Twitter COO Anthony Noto makes his exit. Why the man crucial to the company's turnaround efforts took the top job at SoFi. Plus, Uber CEO Darko Raja plans to put the ride-hailing giant on the road to profitability. Highlights from his conversation with Bloomberg from Davos. And we go to Taiwan to get a behind-the-scenes look at companies that are ushering in the next tech breakthrough. But first, to our lead. A huge shakeup for the leadership team at Twitter. COO Anthony Noto has resigned from the company to take the CEO position at the fintech startup Social Finance, or SoFi. Noto joined Twitter in 2014 as chief financial officer after previously working at Goldman Sachs and has played a leading role at the company. And he has his work cut out for him at SoFi when he takes over in March. Noto will fill a leadership void that's existed since co-founder Mike Cagney resigned as CEO last year amid fallout from accusations of sexual harassment. For more on how this all went down, we are joined by our Bloomberg News tech reporters Selena Wang and Julie Verhage. So, Selena, I'll start with you. How did this all play out? How big a loss is this for Twitter?
This certainly delivers a blow to Twitter, especially just at the very early innings of their turnaround strategy. Since the past few months, several analysts have upgraded the company. They're finally starting to show some revenue and user growth. Now, that being said, Noto did put in place much of the structures that they needed to continue this turnaround, including the live streaming, the content strategy, and really paring back some of the other parts of the business to focus on user engagement. Some sources have also said that this could provide a good opportunity for Jack, since him and Noto haven't always agreed on product vision. And this may be an interesting way for Jack to pursue some other paths that hadn't been possible with Noto right there.
Interesting. Jack Dorsey did tweet, "I'm really sad to see Anthony Noto leave us, but I'm happy for him and really proud of everything he's accomplished at Twitter. He's been a friend, partner, and mentor to me for years. He always has my support and gratitude. Thank you, Anthony. We love you." There was plenty of Twitter commentary about all of this. One of my favorites was, now Twitter has 3 interns and a part-time CEO. I mean, let's talk about the real logistics here of the fact that, they're not refilling this position and what that means.
Certainly. I just got off the phone with a source. It's not clear for sure that they won't fill the position. there's a few steps that they're going to take. First of all, they're going to assess, do they keep the current organizational structure they have now that was reporting up to Noto? It had been Jack was really in charge of the engineering, the consumer part. Noto is in charge of the business structure. Do they want to change that? And if so, do they want to either promote someone to fill that role, or do they want to hire someone from outside? But as of now, of course, they're going to try to disperse that and have their top rank sort of fill in the position that Noto is now leaving. Matthew Dorella will certainly play a large role in that. He leads global ad sales. He has a link to Wall Street, so he'll be the immediate person to fill it in. But you're absolutely right. We have a dual CEO at this company, and without a COO, it certainly presents a problem.
Julie, by all accounts, this seems to be a win for SoFi. What's the word that you're getting from the company?
I think it is a big boom to their business, right? And in many aspects, as Selena is explaining Twitter, I view SoFi as sort of a different thing. It's always been like this darling of fintech and has always done very well. But 2017 wasn't that great of a year in that now all the co-founders are gone. They lost their CFO, their chief revenue officer, and now they finally have some clarity, bringing some leadership in, and a big name nonetheless, too, someone that brings together a good balance of finance and technology that should be good to get SoFi sort of back on track, start answering some questions that a lot of people at the company have too, and sort of, what the direction of this firm is. There were years ago where Cagney said, IPO is on the horizon for, 2016, I think was the original timeline, and we're already in 2018, so sort of where all of that stands now.
I can only imagine that the culture there has been somewhat beaten down by all of these sexual harassment allegations, which didn't just surface with Mike Cagney, but other executives as well. Right. How would you describe the culture at the company right now, the sentiment among employees?
Right. I think right now people are still sort of, want to wait and see what Anthony actually brings in, but they are glad to have an adult, so to say, in the room once again, have a leader, someone to sort of look to, because before it was a lot where, there was no one to sort of say, all right, this is our strategy right now, this is where we're going. Everyone was in wait and see mode for a really long time.
Selena, Twitter's about to report earnings, and the company has been improving when you look at the numbers. What are we expecting? Is Anthony Noto leaving on a high note, essentially?
I think that's a really great way to put it. He has put in place a lot of the fundamentals. He planted the seeds, and now they're ready to bloom. And that's a very opportune time for him to leave. The expectations are good. The analysts I've spoken to don't think that him leaving is going to fundamentally change the thesis about the company, which is that while for a long time Twitter was actually shrinking, they've actually stopped that shrinkage and are slowly starting to grow. One of the metrics that's looked very positive is the daily active user growth. While they don't report the base number, the growth rate has been looking very positive in terms of the users coming to the platform, their time they're spending on the platform. And a lot of that also, let's not forget, should be credited to Jack as well, since he's the one spearheading a lot of the actual user interface and product updates, like the algorithmic timeline and the notification changes, the Explore tab changes. So it definitely has been a team effort between Jack and Anthony, and him leaving is not going to change that.
All right, our Bloomberg Tech reporters Selena Wang and Julie Verhage. We're going to continue to cover this story a bit later in the show. Bloomberg LP operates a global breaking news network on Twitter, I should say, called TikTok. Well, it's an all-or-nothing pay package for the billionaire founder and CEO of Tesla. Tesla has granted Elon Musk a largest of its kind $2.6 billion stock award. If fully vested over a decade, stock options could make him almost $55 billion. In return, Musk has agreed not to get salary or bonus. It appears to be Tesla's way of ensuring that Musk will stay. Still ahead, the Nasdaq closes at a record high as tech stocks continue to rally. We will talk to one hedge fund manager who explains why now is the time to invest in big tech. That's next. This is Bloomberg. A stock we are watching, shares of Netflix surging nearly 10% in Tuesday's trading session, its best performance since July 2017. This after reporting its best quarter ever. And the jump in the stock price has helped push the streaming giant past a $100 billion valuation. And Netflix helped lead the Nasdaq higher in the session, closing at a new all-time high. Those gains helping the massive tech rally we saw through 2017 continue into the new year. Someone who knows a whole lot about this continued pop, Jay Khan of Light Street Capital. Streetlight is a $1.1 billion hedge fund invested in big tech companies like Amazon, Uber, Facebook, and Netflix. Jay, thank you so much for joining us.
Thanks for having me.
So why invest now in tech, and how much of the gains that you're seeing in your fund are tech related?
Well, most of the gains in our fund are tech related. We're TMT focused. And we think it's a particularly interesting time in tech, Emily, despite the fact we've been on a 9-year bull run here in the market in general, and tech stocks have led that run. It's still very early from a penetration perspective. So some of the areas we focus on, e-commerce, advertising, we think we're in inning 2 or 3. For example, in the United States, e-commerce as a percent of retail is about 11.5 to 12% penetrated. In China, that number is 17, 18%, but it's still early. From an advertising perspective, the percent of dollars that are spent online today is still only about 36% in this country. So more than half of the dollars spent in advertising are spent offline. And as companies look more and more towards getting an ROI on that spend and getting targeting metrics back from that spend, they're going to be looking to increasingly shift budgets from offline to online. And we expect the majority of that spend to come out of television.
So, let's talk about the online ad game, which Google and Facebook currently own. You see an up-and-comer, and that's Amazon.
We do. We think Amazon very quietly has been building a multi-billion-dollar ad business called AMS. This business was started a couple years ago, and it's primarily targeted at CPGs. So if you or I do a search today online on Amazon for paper towels, we'll get over 200,000 search results. It's very hard to distinguish product types on Amazon. And I was with the CEO of a Big 4 ad agency in Las Vegas 2 weeks ago, and he mentioned to me that in the boardroom, of every boardroom in America at CPGs, the conversation is around how do I avoid commoditization on Amazon? And the answer to that is spending ad dollars to differentiate that product. If you think about where Amazon sits in terms of the funnel, they're at the bottom of the funnel. They know exactly when you convert and whether you convert. And that's very different than Facebook and Google, which are top of funnel. So Facebook and Google, while they can track you across the web, they may not know whether you actually converted on that product. And that's sort of the holy grail to advertising and why advertisers are increasingly more attracted and thinking about advertising on Amazon relative to Google or Facebook.
So do you think that Amazon could surpass Google or Facebook in the ad market?
It's going to be tough to surpass Google. You know, Google's about an $80–90 billion ad business today. We think Amazon's around a $2 to $3 billion ad business, growing about 100% year over year. We do think, though, over the next 10 years, there's a real possibility that Amazon becomes number 2 and does surpass Facebook.
That's bad news for Facebook.
Not necessarily bad news, because most of that share we think comes out of TV and primarily Google. Facebook's a little bit of a different buy, and then it's more of a brand build as opposed to direct-to-consumer or e-commerce. But that being said, this is very transformational for Amazon. So the street is maniacally focused on whether Amazon is going to do an 8% EBITDA margin, 9% EBITDA margin, or 10% EBITDA margin 3 quarters from now. We think that's the wrong conversation. We think the better comps to look at are Facebook and Google. If Amazon's revenue were to grow to 50%, if 50% of Amazon's revenue were to become advertising over time, we think the business overall could earn a 20, 30, 40% EBITDA margin.
So are you long biased?
We're very long Amazon.
So if you hedge, then how do you do that?
Well, there's a lot of folks that are losing. Traditional retail has been obviously a big area of shorts for us. We've discussed that in the past. But if you think about it from an advertising perspective, each incremental dollar that's spent on Amazon is one less dollar that's likely spent on TV through a traditional ad agency. And so we are particularly worried about the sustainability of the traditional ad agency model, which charges 20 to 30% for every ad placed on television.
So if there is a stock market correction, how are you preparing for that?
Well, we always have to be cognizant that there are exogenous factors that we can't control, but we do tend to run a pretty diversified portfolio, both from a long and a short perspective. And there are a number of industries that we think are being disrupted, heavily over-levered, et cetera, then in a market downturn will go down hopefully faster than our longs.
What about a company like Netflix, which now you see actually the stock price completely divorced from subscriber growth? Subscriber growth is still happening, but it's plateauing, essentially, and yet the stock continues to be on the rise despite these billions and billions of dollars of content, of commitments that they have in original content.
Yeah. So look, the new subscriber opportunity in the United States certainly is starting to decelerate. It's still growing, but decelerating as Netflix moves up that penetration curve. The big opportunity, Emily, is overseas. And when we step back and we think about there are 6 to 7 billion people in the world, half of those are on the internet today. All of those people want to enjoy content. And Netflix is the largest repository of on-demand content in the world. When you think about the cost of Netflix in this country, you're paying roughly $11 to $12 a month. For you or I to take our family to the movie theater, get a babysitter, et cetera, it's probably north of $100. And so the price point is really...
That's why we never go to the movie.
That's why we never go. and that's one movie. But with Netflix, you're getting thousands of movies for that price point.
Just need to get them on Netflix when they come out in theaters.
A little faster, right?
Yeah.
But the point is, I think there's a huge opportunity here to raise price. And we think that Netflix can double, triple, even quadruple prices.
Really? And
not sustain a high level of churn. If you think about it, we're trained to pay anywhere between $80 to $100 a month for cable. Why would we not pay $40 to $60 a month for Netflix?
But what about all the cable options that you won't have? What about live sports?
Live sports is important. There are OTT options that Fubo TV, et cetera, that are offering a la carte on-demand packages. Walt Disney is going to be coming out with an OTT package for sports. So there will be opportunities to consume that. And then you've obviously got Amazon, Google, Facebook, et cetera, likely to bid for some of these rights and take them online.
All right, Jay Kahn, partner at Light Street Capital. Thank you so much for joining us.
Thank you.
We'll see if you're right.
Thank you.
All right, you are looking at a live shot now of the Senate floor as they vote on the nomination of Jerome Powell for Federal Reserve Chair. President Trump picked Powell in November to replace current Fed Chair Janet Yellen when her term as chair ends in early February. His nomination is expected to pass the Senate. We're going to continue to monitor this vote. This is Bloomberg.
Mr. Portman.
A stock we are watching, Texas Instruments, out with earnings, and it gave a sales forecast that fell short of some estimates. Shares declined as much as 6.7% after the earnings announcement. Texas Instruments is the largest maker of analog chips that are basic components of almost every electronic device. The company has shifted its focus away from more expensive digital chips made by companies like Intel and Qualcomm into analog. That has paid off by increasing the company's profitability, but hasn't yet fired up sustained revenue growth. Well, Taiwanese electric scooter maker Gogoro wants to make sure its vehicles don't add smog to the country's air. It plans to launch a trial of its swappable battery bikes in Japan later this year. In the first of our Future Tech Taiwan series, our chief North Asia correspondent Stephen Engel takes a look at how this tech upstart, backed by former U.S. Vice President Al Gore, is disrupting a gas-entrenched market.
Locals call this the scooter waterfall, a daily torrent in Taipei of Taiwan's nearly 14 million motorized two-wheelers, a noisy and noxious, albeit necessary mode of transport. But here's the thing, Taiwan is banning fossil fuel engines in such vehicles by 2035. Sure, that's a long ways out, but startup Gogoro is getting a pretty big head start. Founded by the former innovation chief at smartphone maker HTC, Gogoro is called by some the Tesla of scooters. Stylish, cloud-connected, and juiced by Panasonic swappable batteries.
For about 10 years, the Taiwan government has been pushing for electric scooter to turn this very dirty mode of transportation into cleaner transportation. But throughout the 10 years, it was extremely unsuccessful until we came along.
The Gogoro 2 has the equivalent of a 125cc engine, and they say I can go 0 to 50 kilometers an hour in just 4.5 seconds. Let's give it a go. Top speed is 100 kilometers per hour with a 110-kilometer range. When the batteries are zapped, just swap them out at one of 500 battery kiosks. 30,000 batteries are exchanged every day.
What changed the game ultimately was the way that we fuel the vehicle. Pop it in, within 6 seconds, evaluate whether or not there's anything wrong with the vehicle. It syncs with the server, talks to the server, programs a new battery. 6 seconds, not minutes, not hours, 6 seconds.
Another green tech company not wasting time turning the status quo on its head is MiniWiz. Profitable now for the past 4 years, it turns Taiwan's abundance of manufacturing waste into, at last count, some 1,200 recycled materials, whether it's window shades made of discarded circuit boards or terrazzo tiles from Nike shoes and apparel.
What drives us is anger, actually. With all this new intelligence, all this AI, all this new software that we can play with, I feel like there's not as many people as doing what we can do for the environment.
Both MiniWiz and Gogoro simply want to get toxicity out of our increasingly crowded cities.
Stephen Engel there, our North Asia correspondent. Well, Tencent is investing in a French retailer to help it challenge Alibaba. Tencent and local retailer Yonghui have signed a term sheet for a stake in Carrefour SA's China unit. This investment could help revive the struggling French retailer's hypermarket business in China. The deal would give Yonghui and Carrefour 800-plus stores, second only to Alibaba-backed Sunart. It would also further expand Tencent's WeChat mobile payments across the country. Well, after months of delays, Apple says its HomePod smart speaker will be available for sale online Friday and hit stores on February 9th. The $349 Siri-controlled device was originally revealed last June and marks the iPhone maker's first move into smartphone hardware. The speaker is designed to serve as a gadget to stream Apple Music, get weather information, and control such accessories as lights, door locks, and curtains. It can also serve as a speakerphone for iPhone calls. Coming up later in the hour, Uber CEO Darko Raja speaks to Bloomberg TV from Davos, saying the startup is aiming to be profitable in 3 years. And you can find highlights from Bloomberg Technology on Twitter or send me a message at Emily Chang at Bloomberg TV. And you can also follow along with TV Go on the Bloomberg. You can watch us live. If you miss an interview, you can go back to it. You can send our producers a message over the IB anytime in the show with questions or comments. This is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang. Let's return to our top story. Twitter COO Anthony Noto has abruptly resigned from the social networking giant and is taking the top job at SoFi. Shares of Twitter extended their losses in Tuesday's session, this after falling Monday when reports first surfaced that SoFi was in talks with Noto. Our next guest says Noto's departure sets up some real challenges for Twitter because he was a reassuring voice for investors. Anthony DiClemente, an analyst who covers the company for Evercore ISI, joins us now by phone. Anthony, what do you think the biggest challenges are?
Hey, Emily. So I think that the challenges are that investors want to see this return to revenue growth. And I think Anthony's, under his purview, he was instrumental in getting some video ad revenue onto the system, in decommissioning ad formats that weren't working. So the challenge is really revenue, and then longer term, the challenge is growing that user base. So going from this 330 million or so global users to something that's more scaled. I always think you want to get to 500 million, 500 to 700 million, and I want to see more users. So that has to do with the product, that has to do with just underlying growth, which goes back to making the product better. And then finally, what I would say is that Anthony was instrumental in cost control, and he got margins, profit margins, to record levels. He also, over the last few quarters, under his leadership, engagement was accelerating, and certainly investors like to see that, people checking into their Twitter more frequently. And so my interpretation of this is if he's leaving, there's certainly a possibility that he sees the writing on the wall, so to speak, and that these inflections that investors want to see may not be as realistic or apparent. And so that could be it, but it also could be that he's got a really nice offer at a really exciting company to be a CEO, and here's a very driven, ambitious executive who wants to be the top executive, wants to be the CEO, and it could be a referendum on what he thought his chances were going to be to become CEO at Twitter. So.
Well, my sources have told me that Noto was looking for a CEO job for quite a while, and that right now the numbers at the company actually look pretty good. So this means he's leaving on a high note. That said, 500 to 700 million users, is that at all realistic? Twitter's user growth has been happening in fits and starts and plateaus, and it seems like that is way out of reach at this point.
Well, the issue then is valuation, right? So if you're right, and the target market, the TAM, is constrained to 300 to 350 million users globally, then I think it gets harder and harder for Twitter to grow into this valuation. It certainly trades at a multiple on an EBITDA basis that is quite high, particularly if you look at it adjusting for stock-based compensation. So the way I would say it is that it gets more difficult for them to grow into the valuation unless they could scale the user base. Look, I'm not saying I think there are some encouraging things fundamentally for Twitter going on right now. I mentioned them, cost controls, accelerating engagement, and the ad revenue inflection to positive. The Street is now looking for 7% ad revenue growth in 2018. If you were to tell me that were to inflect further and that numbers are good, then I would tell you that would be heartening for the stock. But it does come at a delicate time, right? Because it's at a time for the stock where expectations are starting to ratchet up a little bit. And now with leadership turning over, there are questions as to how they can replace an executive of this caliber internally at Twitter.
All right. Anthony DiClemente with Evercore ISI breaking it all down there. I should also add Bloomberg LP operates a global breaking news network on Twitter called TikTok. Well, one of the biggest startups on the planet is turning a corner when it comes to profitability. This according to Chief Executive Officer Darko Raja. Bending the company's financial trajectory out of the red would be a dramatic shift for the global ride-hailing service, which has been losing billions of dollars a year. Our Bloomberg editor-in-chief, Jan.23 spoke to Uber CEO Darko Raja from a Bloomberg Live event at the World Economic Forum in Davos. Take a listen.
The core business, the ride-sharing business, can be profitable within 3 years we will continue to make very aggressive investments in building out autonomy because we think that's a terrific opportunity for building out new technologies such as Uber Elevate, where near-term profitability is not a goal, but long-term growth is. So we will look to balance near-term profitability, but as a company, we will always be a company that makes big, bold bets and takes big risks.
To what extent, though, do you think that drive to become profitable fights against a little bit of this culture change? If you want to make, you talked about making money, but not at all costs. Do those two things?
Well, I don't think that profitability and culture are their issue. The company in the past was willing to make trade-offs as it related to how it did business, and I think was guilty of hubris, was guilty of thinking that they knew better than others, and I think that what we know now clearly is that breakneck growth can hide cultural issues, that there are no excuses for not doing the right thing, and that you do have to make trade-offs. And as a management team, we're specifically talking about those trade-offs that you have to make. We have to be a little more patient sometimes because working with governments, regulators, et cetera, sometimes takes longer, but in the end, you build a more lasting business. And so maybe what we went through was necessary, but we're here. We can control our actions from this moment onwards, and I think everyone at Uber from this moment onwards wants to build a great company, not only in terms of growth, but in terms of the kind of company anyone would want to work at.
Can I ask you one thing which you have got as sort of hangover from last year, which is all the regulatory problems, and particularly all the cases against you? I think there are 6 criminal probes or whatever going on. The
lawyers are lining up outside the door.
Which one do you sort of think? Which one do you fear most? I suppose, out of different things.
Listen, I think that all of them are serious issues, and my response is that we're going to be transparent and we're going to take responsibility for our actions in the past. I do think that there are certain circumstances where there was smoke but no fire. And I think as a company, we have to defend ourselves and work within kind of the appropriate frameworks. And my goal is just to get beyond this stuff.
Some of these things like pricing policies, surely they go right to the heart of what Uber is, or am I wrong about that?
Yeah, I think they do, but I think that there's a way of being smart but transparent at the same time, and that's where we've got to take the company.
All right, Darko Raja there, the CEO of Uber, with Jan.23 of Bloomberg. Here for more reaction, Eric Newcomer, who covers Uber for us. You know, what do you make of what Dara had to say? What did you find the most newsworthy?
Definitely the tactful, sort of measured CEO that they all want. I think the dodge on profitability is almost more interesting.
Within 3 years.
Yeah, that's so far away and super non-committal. I mean, you know, this year they're going to have last year they'll have lost like $4 billion. So it makes sense that he's trying to give himself some time to turn that around. But it's just another sign that the margins are sort of a big problem for the company. Yeah, no commitment there, which I think is the biggest news.
What about what he had to say about the culture? And do you believe him that you always have to do the right thing? There's no excuse for not doing the right thing, which Uber didn't do the right thing in many instances, as you have reported over the last several years.
Right. I think it's definitely the right message for Dara, you know, going to London, going to Brazil, negotiating. You know, we're going to be talking forever about whether it was necessary for Uber to break the rules it did to establish itself. But now that Uber's an establishment company, I think saying we always do the right thing, which basically means following the laws while you're being investigated by the Justice Department, is a pretty smart and necessary thing for the CEO of Uber to say.
All right, Eric Newcomer, our Bloomberg tech reporter who covers Uber valiantly, finds all those skeletons in the closet. Thank you. We will have much more from that conversation with Uber CEO Darko Raja later in the show. He'll be talking about autonomous cars. All right, breaking news. The Senate has voted to confirm Jerome Powell as Fed chair. President Trump picked Powell in November to replace current Fed chair Janet Yellen when her term as chair ends in early February. You're looking at a live shot of the floor there. This is Bloomberg. Bitcoin saw a dip today, briefly hitting below the 10,000 mark earlier. The drop comes as Bitcoin so-called forks are on the rise. Those forks are a type of spin-off in which developers clone Bitcoin software to capitalize on the public's familiarity with the digital currency. Some 19 Bitcoin forks came out last year, but as many as 50 could sprout up this year. Joining us now to discuss, Bitbull CEO Joe DiPasquale. Bitbull is a fund of funds manager focused on the cryptocurrency market and currently tracking about 130 funds that invest in crypto. So we're all talking about the plunge so far this year. What's your read on that? Are we going to see a bounce back? Is this a new reality?
We've seen this same dip the last 2 years. We just came out with some research showing that there was a 30 to 35% dip both in 2016 and 2017 around this time. The plunge is due to a couple things. One is profit taking. These investors many of them have been in the market since before Bitcoin was at $1,000. So of course there's some profit taking, and there's seasonality as well, which we've seen over the last couple years, and we saw about a 60-day to recovery in the last couple years.
Okay, so if it bounces back, then how far?
So right now,
how much higher does it go?
Sure. At the end of December, it was at about 14,000. So we saw that 30 to 35% dip. When we saw a similar dip in September, it took about 45 days to recover. So we could see that 45 days to recover to 14,000. There's a lot, as you mentioned, with the Bitcoin protocol that needs to improve its speed and cost of transfer. If that happens, you can see Bitcoin going 2x or 3x this year.
So how are global regulations impacting this? I mean, obviously, you're seeing a lot of mixed messages from countries around the globe.
We are, with Korea and China coming down on ICOs, mining exchanges. That's actually a recognition of how powerful they see these crypto assets. So I think that crypto assets are here to stay. China is right now understanding how they want to deal with it. And we'll see a lot of progress there. But the volatility helps in the active management world. It helps active managers actually take some profits as well.
I wonder if we'll see China and South Korea backtrack, though. I mean, this may be an unfair analogy, but if you look at, China blocking Facebook, everybody thought that that was only going to be temporary.
Right.
Of course, they saw the power of Facebook, and it hasn't changed, and it looks like it never will.
Yeah. So the wonderful thing about crypto assets is there's over 1,400 different cryptocurrencies. So I think what you could see with China is a development of its own ecosystem with cryptocurrencies as well, and that would be very exciting. I think that's just going to take some time to develop.
All right, I do want to take a look at the terminal chart, #BTV. 1928, this shows the slump. This shows how Bitcoin compares to other cryptocurrencies. I'm curious about China developing its own ecosystem. What would that look like?
It could look like other coins. Other regions, like Russia, for example, have looked into creating their own cryptocurrency. It could look like their own exchanges. It could look like their own mining farms as well. So there's a lot in the Bitcoin ecosystem. What Bitbull tries to do is hedge and have investments in the active space that are mining funds and long-only funds and ICO funds with these new coins that come out. So I think there's so much involvement with these crypto assets that really in a year there could be even more than 1,400.
So where are you long and where are you short? Where do you see potential and where do you see potential destruction?
The recent story has been about, so the whole market of crypto assets was at 15 billion a year ago. Right now we're over 500 billion. So that's more than a 30x appreciation. But the story has been about Bitcoin actually lowering its dominance, going from 70% of the whole market cap to about 30%. What we see is these alternative coins and becoming a case for these alternative coins actually disrupting with their blockchains other industries, not only the store of value like Bitcoin does, but also payments, identity management, and other things that I think the story is about the alternative coins. And that's how the hedge fund managers actually profit. They don't just invest in Bitcoin, they invest in a lot of the alternative coins, ICOs, and then of course with the volatility, buy low, sell high, rinse and repeat.
So I'm just curious, as an investor, how's your heart rate? As you watch this go up and down, I mean, do you try to keep a sort of level head about this, or does your heart skip a beat when you see these big moves?
The markets don't stop. I think that for us, we know that our portfolio funds, so BitBull Capital is the first cryptocurrency fund of funds. We have many portfolio funds that their job is to hold in USD or the safer coins and get in at these lows. And that's what they've been doing. So the average BitBull portfolio fund, while Bitcoin performed at 1,400% last year, the average BitBull portfolio fund performed at 3,800% last year. So yes, it's a job, but there's a reason we do it.
All right, Joe DiPasquale, BitBull CEO. Fascinating. Thank you so much for joining us. All right, Comscore is working with financial advisors to explore options, including a potential sale. This according to people familiar with the matter. Comscore, which tracks online viewership and box office results of Hollywood films, is working with Goldman Sachs to reach out to potential suitors. No formal sale process has started, and Comscore may choose not to proceed with any changes, the people said. Coming up, more from our conversation with Uber CEO Darko Raja, what he has to say about the future of the road, from autonomous cars to electric vehicles. This is Bloomberg. Now, more of our conversation with Uber CEO Darko Raja from Davos. He discussed the future of his industry, like autonomous cars, and how technology will help bring changes to the road. Take a listen.
We think there are three keys to transport and where the industry is going: autonomous, electric, and shared. And I think all three are necessary in order to get to the next level of city planning, et cetera. There are many cities where up to a fifth of the space taken in these cities is taken by parking and storing these cars. And so I do think that you need autonomous, you need electric, and you need shared. And I do think it's going to take some time. True autonomy for every single use case is some ways away. What we bring to bear is our developing autonomy, and we will have autonomous cars on the road, I believe, within the next 18 months, not as a kind of a test case, but as a real case out there. And over a period of time, we're going to bring autonomous transportation and feather it in with the non-autonomous transportation with drivers.
What does feathering in mean? Feathering in means to a layman like me? Crashing.
Yeah, feathering in means if you're, for example, in Phoenix, and you make a request to go from A to B, which is what you do with Uber, there will be 95% of cases where we may not have everything mapped perfectly, or the weather may not be the right weather, or there may be an accident on the road, or you may not have 2 or 3 ways of getting from A to B, where you may say, you know what, that's not an autonomous use case. We're going to send a driver to pick that person up. For 5% of cases, everything is going to fall into place. And we will send an autonomous car. The user will be able to pick, do you want there's an autonomous car, yes or no, and we'll be able to service that A for B. That 5% is going to go to 10 and 15 and 20 as our computers and our algorithms learn more and more about what it takes to drive in a city in a real life situation. And every minute of every day, that driver, that computer, is going to get better and know Phoenix better and better and better. And in 5 years, we'll have the perfect driver in Phoenix. We will have to retrain that driver in every single city. We're going to have to build out 3D maps of these cities. And it will take time, but over a period of time, you essentially have a driver who becomes the perfect driver. It'll take 10 to 15 years, but that's the feathering in that I'm talking about.
And will a child born today, will they ever need to learn how to drive?
A child born today? No, I don't think so.
That was Uber CEO Darko Raja speaking to Bloomberg in Davos. We will have more coverage along with great guests from Davos this Wednesday on Bloomberg Television, including a conversation with JP Morgan CEO Jamie Dimon. And that does it for this edition of Bloomberg Technology. A reminder, we are live streaming on Twitter. You can check us out at Technology weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. That is all for now. This is Bloomberg.